That's definitely the theme that we're seeing in the options market right now. So with markets making new all-time highs, the dominant theme in options right now is actually people piling on, adding to upside exposure via the buying of calls and call spreads, basically taking the view that the markets will continue to rally and continue to grind higher from here. And in fact, our proprietary measure of investor sentiment called the Credit Suisse Fear Barometer recently fell to the bottom of the 5-year trading range, telling you that investors really not seeing too much downside risk in the market and are really more concerned about the upside.
And they're not protecting themselves with hedges as a result.
No, not as much as before.
Richard, does that sound like a smart play to you? Is that something you would advise people?
I think I'm the worst short-term trader in the world, so I really can't address that. But I will say
with
that
credentials in front of you. Go ahead.
But I will say with what Mandy's saying about the trading aspect in the options market is definitely not true about overall asset allocations. If you look at pensions, endowments, foundations, individual investors, even to a large extent the hedge fund universe overall, you still see the scarring of 2008. And the people are still very scared about going in full bore. And I think, that the market tops are not, don't occur when you have this hesitancy.
I was going to say, I would take that as a bullish sign.
I think it is.
That not everybody is fully invested.
I think it is. I mean, I can't address the short-term stuff. I'm not smart enough to do that. But you're definitely not seeing it in asset allocations.
Phil, how do you think about all of this?
Yeah, I actually like Mandy's statement in a way about FOMO because I think there is still a lot of upside risks. Look, the U.S. economy is cooking. We're probably going to go 3.5% this year. China's easing up on monetary policy, and Europe is finally showing some signs of life after a very disappointing first half. And so if some of these geopolitical and trade issues get worked out, this is a very stimulatory environment, and that's going to be really good for equity prices.
So if people are coming back after being away for the summer, trying to think of how to reassess things, you would be telling them to go ahead and invest more money in the United States or other places?
Yeah, we're still overweight in the U.S., and I think really our message to ourselves is really to take it easy. And what do I mean by that? Just take it easy, try and ignore some of the noise out there, but the global economy is either cooking or it's being stimulated. And aside from EM, the 3 major zones in the world aren't doing so bad. And if things work out, that's going to be good for equity prices. So you still actually have to go in there, and we're still favoring equities over bonds.
Mandy, when did you first start seeing these positions really ramp up? Was this something that happened gradually over the summer, or is it even more recent than that?
It's more recent, and actually there's been a lot of parallels between the market action today versus what happened at the start of the year in January. If you recall, markets started off in a game-buster way, and in the option market back then, we saw similar upside chasing. So I get a lot of questions about, are investors too complacent? Because we all know.
I was going to say that led to some bad news.
Exactly. We all know what happened in February, but I would say there are some key differences this time around. So yes, in the U.S., equity volatility, if you look at the VIX index, is back to the lows, but volatility is high elsewhere. So in Europe and emerging markets, they're pricing in a much bigger risk premium there. Currently, versus back in January, volatility was low everywhere. So I would say, yes, there was probably too much complacency to start the year, but right now, I do think markets are appropriately priced.